Just a second, and we go to connectivity.
Families never receive the treatment travel because all the families really about it.
It's not there to worry about it.
Answer doesn't care how old you are. He least expected. And it's, yes, more than 5 people go to cancer in the US. The doctor came to me and said, Bob, you don't have to be afraid.
You do get it. Yeah. But you're not understand. I'm communicating with them. All right. Star six. Everybody's on mute. We're about to get underway.
I haven't called them on the phone.
Hi, Haza. Yep, star six. About to get underway. Who is? All right, Samuel, I'm going to have to star six you. All right, I'm muting you. Okay, get underway. All right. Yes, okay. We're muting the line.
I'm on 11 already.
Your line is being muted. All lines are muted. Okay. So there's over 450 participants. Okay. So all lines are muted. I repeat, okay. All lines are muted. There's over 450 participants. So all lines are muted. You can use the chat. Okay. You can use our chat.
This is Bill Briggs and Chris Weaver. Test.
All right. We're about to get underway.
Chris and Bill Briggs, we hear you loud and clear. Can you hear me?
And so here we go with technology.
Yes, ma'am, we can.
I hear
All
you,
right.
Chris and Bill. Can you hear me?
Yes, we can hear you. Can you hear us?
Okay, all right. Step one.
All right.
Yes. So we are assembling at last. I checked, there were about 450 people signed up for this webinar. So folks are assembling, and we should get started shortly. Our CEO, as well as our founder, may be on at the beginning of the call to welcome everyone. So stand by.
Okay, sounds good. All right. So, and you have us for 10 to 15 minutes, correct?
Speaking, I have you on for about 20 minutes.
Okay.
Or you'll say your section, and then we'll take some live questions. You've gotten some that I already got.
Right. And some of them, I'm just going to be honest, I can't answer at this time, but we'll take them as we get them.
Okay.
And obviously, Chris will have some remarks too to show the collaboration with Treasury, and he'll have additional things too that will be of interest to this audience.
Okay, sounds good. Okay. Okay, okay. Let me just check one thing, and then we'll get started. All right. So I think we have Jesse Van Tol, NCRC CEO, on. And Jesse, do you want to get us started? Or?
Sure thing. Can you hear me?
I most certainly can. I think everybody can hear. So.
Okay. I don't see my video up, but perhaps others can see it. All right. Well, welcome everyone to our webcast today. We're doing a deep dive into the CARES Act. We've got some terrific speakers joining us today from Fannie Mae, from Freddie Mac, from SBA, and from FHA, going to give us a great read on various measures their agencies are taking. This is one in a series of webinars we're doing for our members, for our partners, for people who work with us, and we're glad to have over 200 of you on the line today. So just thank you. We appreciate the work that you do. We thank you for joining us, and thanks also to all of the key players who will be on today, sharing intelligence and information with us. So we've got our work cut out for us. NCRC continues to advocate around future stimulus funds to make sure that they are targeted, that PPP funds, for example, get to some of the smallest businesses that have been hardest hit, and that there's adequate funding for things like housing counseling, for CDFIs in the future round. And as we continue to engage with SBA, FHA on what they're doing, and directly with Fannie and Freddie as well in terms of assisting homeowners. So with that, I'm going to turn it back to Jerron, who is sitting in front of a lovely fireplace, a little fireside chat here today for you all. And once again, just thank you for what you do. Jerron?
All right. Thank you, everyone, for joining us. I do want to say at the outset, Jerron Levi, Director of Government Affairs here at NCRC. And I do want to just make clear that you're all muted. but we will be taking questions through the Q&A function. And that Q&A function is in the bottom right-hand corner there. With that, I'm going to turn immediately to the Small Business Administration, and guess we have on the line. I'm very honored to have Bill Briggs, the Deputy Associate Administrator for the Office of Capital Access at SBA, and also Christopher Weaver, who has been detailed to the SBA from the U.S. Treasury Department, and it's heading up the SBA's interagency work group around some of the work around the Paycheck Protection Program. And so with that, I'm really going to turn it over to these wonderful speakers who have a lot of great information to share with us, and we'll be on for a few minutes to take some questions. Go ahead, guys.
Thanks, Jerron. This is Bill Briggs, and I am joined by Chris Weaver, who's our Senior Advisor to the SBA Administrator, and I have particular focus on CDFI issues. I asked him to join me today. As Jerron stated, my title is Deputy Associate Administrator for the Office of Capital Access, and in normal times, my job is to help small businesses access capital on reasonable rates and terms. We do that through our regular 7A loan program, our 504 program, and our microlender program, which many of you may be familiar with. We are in anything but normal times. We are in unprecedented times. And in response to that, Congress and the administration created and are now executing on the CARES Act, and in particular the Paycheck Protection Program, which I know is of interest to many folks on this call in particular. I do want to respond that just at the outset that SBA obviously has gotten a lot of attention for the Paycheck Protection Program, but we also have done great work in the areas of government contracting. We had an announcement yesterday from our government contracting unit about how our focus on helping women and minority, women-owned and minority women-owned businesses access and better enter the field of government contracting and benefit from that area, as well as our disaster response, our normal disaster response when there are fire, flood, emergencies, what have you. Our disaster response team has been part of that. I assure you're also aware of our economic injury disaster loans. The paycheck, but I'm going to, today, because of my primary focus is the Paycheck Protection Program, I'm going to focus my remarks there. This program is unprecedented for many reasons. And one of the key features at the outset was that nonprofits would be able to apply and participate in this program, as well as houses of worship that had been a departure from our traditional 7A program. We also are making an aggressive effort to include lenders and particularly CDFI community and MDI community to participate as lenders and address their concerns. During this second round of paycheck protection lending, I'm proud to report that we have over now 302 CDFIs who have just in this round thus far almost made $3 billion in loans, approximately 52,000 loans. And so the CDFIs are certainly holding their weight in this round, and they certainly held their weight in the first round. I think both CDFIs and MDIs did over $10 billion in loans during the first round of the Paycheck Protection Program funding. So we have more to do, though, and during this round, we are particularly focused on making sure that underserved communities and minority communities and those who may not benefit from the first round of Paycheck Protection Program funding are benefiting this round, and that we're taking into consideration how we can use the program to make sure that we are hitting markets that may have missed the first time. And so Chris Weaver has been helping us in that regard, and as with everything with the Paycheck Protection Program, it is a joint collaborative effort between SBA and Treasury. So of interest to many folks on this call will be the forgiveness guidance. I'm sure there will be questions about that. That is a joint collaborative SBA effort. So all forms, policy guidance and all of that are done together with Treasury. So I thought very appropriate to have our colleague, Chris Weaver, on this call as well. Jerron has sent me some questions in advance, so I'm aware of some of the issues that this group may be interested in. I may not have answers to everything, but we can certainly consider them. This is part of the aggressive outreach that the administrator has asked me and Chris Weaver to do particularly with the CDFI and MDI community and that lender cohort, and to make sure that we are doing everything to engage them. I am not talking to big banks. I am not talking to massive lender trade associations. I'm only talking to CDFI groups and underserved communities right now, do everything I can to educate them about the Paycheck Protection Program and how they may benefit, and also take into special considerations. So we have taken some steps along the way, particularly in this round of funding. There was a time, I believe, on April 29th, where we paused funding for all but the smallest lenders, those lenders with assets under $1 billion, and with the idea that those folks had a chance to catch up and make sure that their loans got processed and that they would be able to serve their customers. That's one small step we've taken, and we're continuing to see how we can better serve, in particular, the CDFI community. So we want to hear your feedback, even if it's not all great. We are aware we have more to do. And with that, I also want to turn it over right now to my colleague, Chris Weaver, for some remarks as well.
As Bill mentioned, my regular job, I'm the director of the Office of Consumer and Community Policy over at Treasury. And when the administrator came over and took over here at SBA, she made it known that she was very interested in trying to work closely with underserved communities, underserved markets. And so having worked with her at Treasury, I came over on a detail to assist her with that mission. So about half of my responsibilities specifically relate to trying to make sure that we're reaching all markets here at SBA. As part of this PPP process, she took the initiative and created an interagency working group, which I was asked to chair, and it includes representation from not only SBA, but also the White House, from the Treasury Department, from HUD, and from MBDA and Commerce. And so it's an interagency working group, and it really has three purposes for the working group. Well, first off, the overall mission is it's not only just thinking about the emergency, the issues related to small business on the emergency from COVID, but also pivoting to what needs to be done in terms of the lasting impact of COVID, what we should do in terms of thinking of legislation in the future for recovery from this. So this working group is put together to try to reach out to the community and to find out what the needs are going to be of small businesses to help them recover from this in the long run. And so that consultation with community groups, with CDFIs, and with other stakeholders is one of the key parts of it, but that's just one part of the three-legged stool. We also want to track where we are in terms of progress, so really working with the Treasury Department and the Econ Policy Office to gather up the data on where we are and where we need to get us back on the trajectory we were pre-COVID. And finally, making recommendations to the administrator as well as to the White House on policy recommendations, what we can do going forward. So that working group is a big part of my work here. I look forward to having more communication with those on this call, because we want to, as part of our consultation, talk directly to small business owners and get their feedback, as well as some of the intermediaries that work with them.
So, Jerome, with that, I think maybe the time is best served by trying to answer some of the questions as best we can right now, and then have some engagement. So we'll let you moderate the questions right now.
Okay. Well, first up, we've gotten a lot of interest in the data that you're releasing. So SBA traditionally releases loan level details on SBA loan originations. That includes the business, the location, the details of the loan, amount, disbursement data, etc. First of all, we would like to ask that the same data be released for SBA loan application. So what are your plans around the data? For example, I think I mentioned in advance, and I don't think I missed this in your presentation, a lot of folks are interested in how MBE, minority business enterprises, women business enterprises, and other, mom and pop micro businesses are participating in the program. Just share whatever you can say about those things. What additional disaggregated data you might make available, and the MBEs and all of that, if you can say anything about it.
Yeah, and I fully understand the question. And just to give some context, in our normal 7A program, our best year was fiscal year 18 to date. We did $25 billion. We have now done over $535 billion worth of paycheck protection loans that benefit over 4.2 million small businesses, nonprofit organizations, and their employees. So the volume of data that we are dealing with is really new for SBA in that regard. We are trying first to make sure that data is validated and accurate, so that any data that we release, it's thoroughly scrubbed in terms of being accurate and sufficient. So every day right now we are releasing on SBA.gov/paycheck protection the overall numbers that show we're approximately, during PPP round 2, we have done $192 billion, which means that there is approximately $118 billion left in funding for all types of lenders to offer small business borrowers. The second thing I would note, and that information is updated daily, approximately 6 o'clock every night. We are also releasing weekly summaries now every Sunday evening that will specifically show the CDFI data as well as the MDI data. This is by lender data, as well as a breakdown of other types of lenders that generally have under $1 billion in assets. So we're providing that kind of summary data. In terms of the loan level data and all of that, we are working through a process to release that information and do it in a thoughtful way. I understand, too, that we are trying to find, as you may be aware, the application had limited information in terms of demographics and all of that. So we're trying to work through and get a better sense of the communities that we have served. So that data will be coming out. I can't commit to a time frame at that point because I know we are still obviously making loans. We want to make sure it's accurate. But the other thing, too, is I would note that, and the one thing we are very pleased to see in the second round is that in the first round of PPP 1 lending, the average loan size was $208,000 or $206,000. It is now under $73,000, and it is dropping every day. And that means smaller and small businesses, the moms and the pops, the people that we truly want to benefit are accessing the program. Additionally, people who may have not been as engaged and as educated about the features of the program are having a chance because the money is not being used as quickly, or the burn rate, for lack of a better term, is not as fast as it was during round 1 or even the first week of round 2. So we see that as benefiting businesses that may take more time for education and engagement and awareness of general about the PPP program. So we do hope to release more information in the future, and that is our plan, but I can't commit to a time frame right now.
Okay. Can you say more about, and I was multitasking, but can you say more about the loan forgiveness provision? I know you're in the midst of guidance. Can you go ahead?
Right. So I generally can tell you the process, and again, it is an interagency process that both SBA and Treasury are actively working on right now. I'm hoping in the very near future, but I obviously can't commit to a time frame that both that guidance and an application for forgiveness will be put out. So just as a borrower would apply to receive a PPP loan, they will apply to have that loan forgiven, and there will obviously be some sort of documentation required. It is not, we're working through that right now. We understand, we've heard concerns that underserved markets, self-employed, sole props, and all of that may have. We're taking those into consideration to not make it overly burdensome and difficult. But there will be an application. I can say that there will be an application that people have to apply for forgiveness, and that the guidance will there help both lenders and borrowers throughout that process.
Okay. I am now going to ask some specific questions, and I'm just, these are just individual concerns, but I think they probably reflect what other folks are going through. Okay, so we received the PPP loan. We are a nonprofit that operates 7 food pantries and have a family education department that is still working in the homes to assure the safety of children and youth. This has placed our staff and their families at a very high risk of contracting COVID-19. If we were to implement hazard pay or a bonus of some sort to reflect this concern they are facing on a daily basis, will this be forgiven at the end of the loan? Well, you may not, I don't know. Go ahead. That's just a question. Go ahead. It's whatever you can do it.
I want to try to phrase a scenario. So this nonprofit in question has applied for a PPP loan. They estimated their payroll calculation costs up to $100,000 of salary and other identified payroll costs. And now there may be additional cost with hazard pay and so forth. And will that be eligible for forgiveness as well? I think it's a little bit the cart before the horse, because if they already have the loan, was the hazard pay included in the original calculation would be the first question. And if the use of proceeds in terms of, are you using more of the proceeds therefore on what you would consider payroll costs is to be determined. It also, quite frankly, may determine on the size of the loan, as has been publicly stated by the Treasury Secretary, and the administrator that loans over $2 million will be reviewed. So there's multiple factors in that, and generally hazard and commissions and bonuses are not included in the payroll calculation. But that's something where if it's appropriate, we would receive feedback from the nonprofit community and your organization if that's something we should consider.
Okay. I received I'm going to give you a couple specifics and then some general. I received a $10,000 grant and the PPP grant. Okay. I know that there are limitations on using the funds, but cannot not find out what they are. SBA, quote, tier 2 line is too long. Is there anything written that I can refer to? He goes through what he wants to use the money for, like helping our senior clients financially and as they move into subsidized housing and things like that. Can I use the $10,000 money for insurance payments that cover a full year? Anyway, is there anything written that he can refer to?
So I think when he's talking about, I think there's both an economic injury, EIDL advance, which is that $10,000 grant, and then the PPP loan, and the intersection of those two. Generally speaking, you can use the EIDL loan for all sorts of what we would call working capital or costs associated with running the organization, and the PPP is specifically designed for payroll. So you just want to be careful how you're documenting how you're using the funds and identifying that the PPP payroll proceeds are going for payroll, and EIDL that grant can be used generally as they see fit. I mean, that was the idea.
So the EIDL is a little bit more flexible, but there are some ineligible uses for EIDL, and I'll read them off, but they are on our website. So you can't use EIDL to refinance long-term debts. You can't take it and go pay down a mortgage with it. You can't repay an SBA loan with it. You can't pay tax penalties or civil fines with it. You can't repair a property with it, and you can't make dividends or distributions to owners or partners with it. But other than those ineligible uses, the EIDL is very flexible. You can use it for almost anything.
Are both loan and grants limited to the 8 weeks starting the day I had the money deposited in my account? Do I need to calculate daily wages to the exact 8-week period? That may be.
If you're asking about the 8-week period, that's for the PPP. That doesn't apply to the EIDL.
Okay, all right. This is all from the same person.
Right. Sometimes they are different programs, but people get them confused. It's very understanding.
Oh, okay. Well, on the PPP then, the 8-week period, whatever you could say.
Yeah, I mean, generally, so if you're calculating up to $100,000 in salary and other payroll costs, which could include state and local taxes, employee benefits, those are additional payroll costs. So if you're over an 8-week period, let's say you have $10,000 in salary costs, but you may also have $8,000 in your state and local taxes and your employee benefits as well, then you would take out your EIDL your PPP for potentially $18,000 as opposed to just $10,000 for the salary. So you want to make sure in terms of calculating your daily wage, it's just more you could look at your general payroll costs over an 8-week period. It's not a daily calculation. It's meant to be essentially an estimate, a good faith estimate of your payroll costs as defined by the CARES Act, which would again include state, local taxes, employee benefits, as well as salary up to $100,000.
Okay, jumping around a bit here. For SBA, will EIDL loans be reported to the 3 major credit reporting agencies, if you know?
You know, we have to get back to you on that, Jerron.
Okay, no problem.
Yeah.
Okay. No problem. Do you know what is left in the disaster loan fund? And if you don't have the answer right off, it's fine. I'm just going through what people are asking.
Yeah, no, I don't. So that's the Office of Disaster Assistance. I'm trying to stay in my lane, but you did address minority businesses to some degree in your comment. Are you able to comment any more about the level of access by minority-owned businesses? I may have missed, I was multitasking, so you may have already addressed this, but can you say any more about it? Did you hear me? Yeah, I'm just, well, part of what we're doing is there was, when I talked to Chris a few days ago, there was a sense that the money, quote unquote, had run out, and we want to make sure that the communities and the CDFI community in particular, who serve the underserved markets, know that there is approximately $118 billion left, and that there is some time. It is not going out. The money is not going that quickly, and that there are opportunities to take the time to try to engage people who might not have been engaged before, and use that before June 30th. And so part of why we're trying to do these outreach calls is to say, look, please stay engaged. Please engage people who you think might be able to benefit, particularly from minority communities, that there are still funds available, and that that we have the self-employed sole props and those types of organizations could, which may be of interest to underserved communities and minority communities, are eligible and they can participate in this program and should.
And Jerron, just quickly, as part of our outreach, there's 2 things that were really glaring that we tried to address. And one was a lot of the CDFIs that were working with underserved communities, is they had liquidity issues. And there's liquidity, and then there's the timing. A lot of those borrowers needed more technical assistance and took a little longer to get their applications in line. The timing issue isn't completely eliminated, but it's given that we have $118 billion in the process of slowed down, that's been alleviated a little bit. So there is still time to work with them. The liquidity issue, we worked with some banks to try to provide liquidity for CDFIs, and most notably Goldman Sachs pumped $500 million working with SBA into CDFIs to try to make more capital available to those CDFIs. And we're still having those conversations with others to do similar. So
okay.
We're trying to address both the liquidity and the timing piece.
Okay, we only have 2 minutes left. 2 minutes countdown here. We were approved for a larger loan than we need. We have less employees than this year than last year. The full loan was deposited. If I only use a portion of that for payroll, can I pay back whatever we don't use? And will forgiveness be calculated based on using 75% of used amount on payroll instead of calculating forgiveness based off of 75% of total amount approved loan amount? Sorry, I know that was complicated.
Yeah, no, I hate to say it, but the safest statement, rather than this particular example, is that the guidance will be coming out. We know there are many situations that are not perfectly aligned with the 75% payroll, 25% other cost, or that there's been requests to flex the 8-week period. In other words, that when the borrower gets the money, gets the loan proceeds, that they can essentially say, this is when I would like my 8-week period to begin. So there have been requests and there are policy deliberations around that. But the safest thing for me to say, the most accurate thing, is that the guidance will be forthcoming on the forgiveness in general.
Okay. 3 real rifle shots real quick, and this is it. First of all, repeat your CDFI numbers, the ones that in the first and second rounds, if you can. Is the 8-week period on an accrual or cash basis? That's the second one. And the third one, I got several questions about newer enterprises that just got started up, that are newer, and whether they would qualify for a PPP. So can you address those, and then we'll conclude there.
So right now, and you can see this data on our SBA.gov/paycheck protection. Under the additional information section, you can see the daily number, but you can also see some PowerPoints that provide a more detailed summary, in particular how CDFIs are. So if you look at the website on that, to date we have over 302 CDFIs participating. We have 122 MDIs. As you may know, that there are institutions that are both. We have approximately 28 of those. But the CDFIs have done over 52,000, I think just around $3 billion worth of loans just for round 2. And in the MDIs, I think they have done a little bit more loans and loan volume. I'll double check that. I don't have it in front of me right now. I want to be accurate, but it is on the website. I think generally in the first round of that 349 billion, there was I think, and I have to again double check those groups. Both the CDFI and MDI did approximately over $10 billion worth of loans during the first round. So they are making their presence felt noticeably, and we want more. We want more participation and volume, and that's part of what
we're going to give it to them.
Okay.
We're going to give it to
I forgot the second questions. I'm sorry.
8 weeks on accrual or cash basis, and can newer enterprises that just got started up, say in January, qualify for PPP?
I think on the newer one, you have to be in business by February 15th of this year.
Yes.
And
true.
then on the accrual or cash, I'm not sure. I got to punt on that one. I'm not sure exactly.
That's up to your CPA. We have a CPA in our midst, and all Black folks plan people are in line with being in the
a lot of
guidelines.
things in motion quite, rapidly. Thank you so very much, both of you, for joining us and offering your expertise. And we may follow up, but thank you so much for joining us today, gentlemen.
Thank you, Jerron. Thank you.
Okay. All right, everyone. With that, we're going to move to the Federal Housing Administration. Again, we have great speakers here. Joe Gormley, who is the Deputy Assistant Secretary of the Office of Single Family. He has two of his colleagues also who are on the line with him. Joe, if you can introduce your two colleagues, that would be terrific. And with that, get started. We're so pleased to have you on the call today.
Thanks, Ron. Can you hear me?
I most certainly can.
Excellent, excellent. I like your fireplace. It's
give a Zen feeling.
So yeah, happy to kind of catch you all up on what FHA has been doing, and then afterwards, I understand we have some time for Q&A, so we can get into that. Without further ado, so good afternoon, everybody, or morning if you're on the West Coast. I'm glad to be here with you all today, even if it's just virtually. I want to say thank you to NCRC for giving us this forum today to discuss some of the important actions FHA has taken to help borrowers with FHA insured mortgages since the beginning of the COVID-19 emergency. As Ron mentioned, I'd also like to introduce two of my colleagues who are both experts in FHA servicing policies who are here with me today. Lisa Saunders, who's the Director of the Single Family Office of Asset Management, and Matt Martin, who's our Director of the Servicing and Loss Mitigation Division in Oklahoma City in the Office of Single Family Asset Management. As most of you know, FHA is the largest mortgage insurer in the world. In fiscal year 2019, we insured approximately 1 million loans. Today, FHA has nearly 8.2 million single-family forward loans on our books, mostly made to first-time, low to moderate income, and minority borrowers. By any measure, we are a large and critical part of the nation's residential mortgage finance system. Given our portfolio, it's a certainty that we're going to be responsible for helping many of the families with FHA-insured mortgages during this time of national emergency. Since the COVID-19 pandemic began, FHA has been working hard reviewing its policies and procedures, looking for ways to make it easier for homeowners who lost jobs or who have been furloughed because of COVID-19 and might soon have trouble making their monthly mortgage payments to stay in their homes. I want to quickly review some of the major loss mitigation policy actions FHA has taken so far. On March 18th, FHA published Mortgagee Letter 2020-04, which announced an immediate foreclosure and eviction moratorium for all FHA-insured single-family mortgages for a 60-day period. This policy ensures that no individual or family will be foreclosed on or evicted from an FHA-insured property during this period when we all are told to stay home to limit the spread of COVID-19. The 60-day moratorium applies to new foreclosures as well as completion of in-progress foreclosures and prohibits single-family borrowers from being subject to an eviction. The ML also extends reasonable diligence timelines for HECM servicers, which will permit them to be more flexible with senior borrowers and allow them additional time to resolve any issues with their loans. I want to be clear that we know the foreclosure and eviction moratorium and the other policies affected in response to the public health emergency through Mortgagee Letter 2020-04 are scheduled to end on May 18th, and we should have an announcement later this week to provide some additional clarity going forward. On April 1st, FHA issued some of our most important foreclosure loss mitigation guidance designed specifically to help borrowers facing financial hardships because of COVID-19. Mortgagee Letter 2020-06 implemented provision of the CARES Act concerning forbearance and also announced our new COVID-19 standalone partial claim to provide loss mitigation options to impacted borrowers. COVID-19 forbearance is available to all borrowers impacted by this crisis, whether directly or indirectly, and does not require documentation of a financial hardship. If a borrower can still make their mortgage payment, they should be encouraged to do so. However, if the borrower requests a forbearance, the servicer must give them requested forbearance. Under the CARES Act, borrowers are entitled to request an additional forbearance of their monthly mortgage payments of up to 180 days and may request an additional 180 days if needed. The policy also waives late fees and penalties and suspends negative credit reporting. This will provide significant relief and ease of stress for borrowers and servicers alike. When requesting a COVID-19 forbearances, servicers should work with borrowers to educate the borrower on the impact of longer forbearances, ensure that borrowers understand that missed payments must be repaid, although no lump sum payment is required at the end of forbearance, educate the borrower on what repayment options will be available to them to make repayment, and inform borrowers that they can contact their servicer when their hardship ends to resume making their monthly mortgage payments to end the forbearance and discuss what repayment options are available. FHA also developed the COVID-19 standalone partial claim to assist with repayment. If borrowers were current or less than 30 days delinquent as of March 1st, 2020, they may be entitled to this option. Partial claim is a zero-interest, no-fee junior lien on the borrower's property that will become payable when the borrower sells their home, pays off their mortgage, or their mortgage otherwise terminates. If the borrower does not qualify for the COVID-19 standalone partial claim, FHA offers tools to help the borrower repay their missed payments over time. As you can see, FHA has made and continues to make important changes to its forbearance and loss mitigation policies to ensure borrowers impacted by COVID-19 do not have to worry about not being able to repay their mortgages and risk foreclosure during these unprecedented times. We continue to look for ways to streamline our loss mitigation policies to reduce burdens for borrowers. Given the large number of forbearance actions we are seeing, and knowing that we will probably see these numbers grow, we will continue to improve our policies to ensure that servicers are able to effectively service these distressed loans while helping borrowers remain in their homes. FHA has several resources that are available to servicers and borrowers alike to learn more about our loss mitigation options. You can email us at answers@hud.gov contact our FHA Resource Center at 1-800-CALL-FHA, or visit our new joint consumer website with CFPB and FHFA at www.cfpb.gov/housing, which consolidates the CARES Act mortgage relief, protection for renters, resources for additional help, and information on how to avoid related scams. It also provides lookup tools for homeowners to determine if their mortgage is federally backed, and for renters to find out if their rental unit is financed by FHA, Fannie Mae, Freddie Mac. Thank you, and now I'm ready to take some questions, Jerron.
All right, thank you. So I know I sent a couple questions to you about the partial claims.
Yes.
So let me just follow. One is pretty technical, but one is not so much. I think you touched on it a little bit, but for FHA COVID-19 partial claims, which may be granted at the end of the COVID-19 forbearances, only borrowers with less than 30 days in default as of March 1st, 2020 will be eligible. How are you dealing with distressed homeowners before that date who had loss mitigation applications pending? Maybe they were on trial payment plans and have now lost income. Can you speak to that?
The full suite of other FHA loss mitigation options continues to be available to those borrowers. And as I said, we're also looking at what additional policy tweaks we might make to assist all borrowers. So, that's really what I can say right now about that.
Okay. I also sent you another question about the 24-month rule.
Yes.
You stated in a previous webinar that the 24-month rule did not apply to COVID-19 partial claims. I guess one of our was saying they hadn't seen this in writing from HUD. HUD has not yet stated whether the 24-month rule applies to an FHA HAMP standalone modification and or a traditional partial claim. That might be the only home retention option due to COVID-19. And so, someone wanted me to ask HUD to include all of these answers in your fact sheets and frequently asked questions for servicers.
Absolutely. So I think I can provide a little more clarity on that. The COVID-19 loss mitigation policies published in Mortgagee Letter 2020-06 do not state that a borrower does not qualify for a COVID-19 partial claim if they have executed an FHA HAMP agreement in the past 24 months. In this way, the COVID-19 loss mitigation policy mirrors FHA's presidentially declared major disaster area loss mitigation policies in our handbook. The standard FHA HAMP section of the handbook on default servicing, we plan to update so that this exception on the 1 and 24-month rule is clearly laid out to indicate that we're going to treat those loss mitigation options the same way as we do the PDMDA options.
Okay. I did, and I'm reading the questions. I was multitasking a bit, but did you deal with the whole lump sum issue? It is an area of tremendous concern. I think your Inspector General has, also looked at some of the servicer websites, and there's a lot of different information out there. Maybe you can speak to how you're dealing with servicers and the lump sum issue. Did you address that already?
Yeah, I touched on it, but happy to go back, kind of circle back and
let me say this. This is the issue of whether at the end of a forbearance, a borrower is going to face having to repay all of the what is owed in a lump sum. Now, you have your partial claim process, but anyway, we get a lot of questions about that, so go ahead.
I think
services on that.
There's been a lot of media attention on this, and you mentioned the IG or HUD IG did a report on this, I think 2 weeks ago. So just to be clear, at the end of FHA's COVID-19 forbearance, the borrower is never required to make the lump sum payment at the conclusion of the forbearance. So as an example, if the borrower took 6 months of forbearance and then resumes paying, in month 7, they are not going to be required to make those 6 months of missed payments. For most borrowers, what's going to happen is those missed payments through our partial claim process get tacked on as a subordinate lien on the first mortgage, and most borrowers will not end up paying that until the mortgage ends, either at refinance, when they sell the home, or at the end of the mortgage term.
Okay. All right. Do you have more to say? I've got a bunch of FHA questions I overlooked, and I need to go. Are you done, or were you
No, that was it. Thanks, Sean.
Okay. What are the repayment terms? Okay. How? Let me see here. I've got a lot of FHA questions, but they got mixed in. Is there a chance that FHA will suspend the requirement that 24 months must pass before a homeowner can qualify for a new modification? Did you already address that?
Yeah, I know. I addressed that in the answer.
Okay. Can you just go over the COVID-19 partial payment plan?
I'm not sure that I understand the question.
Okay. How does the CARES Act apply to reverse mortgages? Can you speak to reverse mortgages?
Yeah, so in our mortgagee letter 2020-06, we announced some additional, the reverse mortgage does not work exactly the same way the forward mortgage does. There's no payments, so there's no need to defer any mortgage payments. But we did announce some additional flexibilities under our mortgagee letter 2020-06 to help borrowers who may be experiencing difficulty making taxes and insurance payments.
Okay. Can you emphasize the info on partial claims and the meaning of quote unquote standalone partial claim? Did you go over that already?
Yeah, maybe it's worth just offering a little bit more color. So our COVID-19 standalone partial claim is based on the disaster standalone partial claim that we used after the 2017 hurricanes. As I indicated, for most borrowers at the end of the forbearance period, that partial claim is going to be rolled into a subordinate lien, which stands behind the first mortgage, and which they will not be required to repay. Which they will not be required to repay until the end of the mortgage refinance, when they sell the home, or at the end of the mortgage term.
Okay. Please confirm, and I know the CFPB has put something out on this, but please confirm if there will ever be a negative impact on credit score for those that use payment forbearance.
So what I can say is, under my understanding of the CARES Act, and certainly of our policy, is that servicers are required to report loans that are in forbearance in the current status. I know there's been some discussion about whether or not additional information can be reported to the credit bureaus. With that, I think that the credit reporting falls under the Fair Credit Reporting Act, and that's actually under the CFPB's jurisdiction. But under our policy, if a borrower is in forbearance, the servicer must be reporting them as any current status to the credit reporting agencies.
Okay. What about borrowers who have already maxed out their partial claim?
Yeah, so unfortunately, due to either a previous financial difficulty or through an experience after a disaster, there are some population of borrowers who have exhausted their partial 30% partial claim amount. That's a statutory limit. The other FHA loss mitigation options still apply. And we're also looking at, as I said, how we can kind of streamline those processes for those borrowers going forward.
What happens to escrow payments for taxes and insurance during the forbearance period?
So whether the borrowers are required to make them or I'm not sure I totally understand the question.
Yeah, this, they're still forwarded to the local jurisdiction, but
yeah. So generally, the servicer's going to be on the hook for making those payments. Obviously, for some borrowers, there's going to be the escrow account is going to be able to cover at least a couple months of float. As I said, the servicer is going to be responsible for making those payments once that the escrow account is exhausted.
Okay, I'm just reading them off here. What would the process be like at the end of the forbearance period for the COVID-19 standalone partial claims? Is there any documentation needed, required proof of hardship, etc.?
So under the CARES Act and FHA's policy, there is no documentation required by the borrower when they ask for forbearance, or when they come off of forbearance.
Okay. So at the end?
No, correct. There's no documentation required. When the partial claim is executed, the borrower and servicer, the borrower is going to have to sign an agreement to have the lien subordinated on their mortgage, but that's really the extent of the paperwork.
Oh, okay. So the lender, the servicer, okay, that's okay. You're not requiring anything. Can they require something?
Can the servicer require proof of financial hardship? Not under our current policies, no.
Okay. Okay, let's see. Will FHA insure mortgages that go into forbearance after closing but before endorsement? Will Ginnie Mae securitize them?
So I can't speak for Ginnie Mae. My understanding is generally Ginnie Mae will securitize a mortgage. I believe that's not more than 30 days delinquent. We are aware that some small population of loans is going into forbearance between closing and endorsement. Is something that I can say that we're looking at, and hopefully we'll be able to address in the next few weeks.
Okay. When you receive the FHA partial claim, will forced place insurance be put on the loan, thus driving up the escrow? I'm just giving them to you.
Yeah, I'm not sure I totally understand the question. I'm happy to take that one back to the staff and maybe follow up with you with an answer.
Okay. All right. I think this is the last one. Is that 30% of the loan balance on a partial claim, or two things? Do you understand that question? I'm not sure I understand that question.
I'm sorry, I'm not actually looking at the question.
No, I'm saying, is that 30% of the loan balance on a partial claim? I think they were referring to something you said earlier, but.
So under our statute, the partial claim, your partial claim is limited to 30% of the unpaid principal balance.
Okay. And we're within a minute here. What is the interest rate on the partial claim?
It is a interest-free subordinate lien. So when the subordinate lien is paid off, as I said, usually at the end of the mortgage, when the borrower refinances or sells, if the if when you executed the partial claim, it was $3,000 and 20 years from now, you have to pay back that partial claim, it's still going to be $3,000. There's no interest.
Okay. In our remaining minute here, I am interested in how this is impacting new endorsements, credit standards going forward. Have your credit standards changed? There has been some press reports that, you know, your FICO scores have increased. I'm talking about new borrowers who,
Sure.
you know, what's happening with new credit and new endorsements?
Yeah, absolutely.
A trend you're seeing?
Yeah, so just to be clear, I mean, FHA has not changed its underwriting standards since the beginning of the crisis. You know, anecdotally, and I think from media reports, you know, we've seen some lenders changing their standards. I think, you know, whenever you experience financial downturn, you always see some of that where the market tries to find equilibrium. Something we're monitoring closely. I'll note that last month, actually, Ginnie Mae had its largest month. You know, they securitized the largest dollar volume of loans ever. Of course, a lot of that's refinance business, but there's still a pretty healthy purchase share. And we're in contact regularly with warehouse lenders that provide lines of credit to the IMBs. We're talking to the depositories about their standards. So I think there's much more to come in that area, but I'll just say it's something we are watching very closely.
Okay, well, we appreciate your time. Thank you to you and your colleagues who have joined. You know, for taking this time out. I think it's been very, very helpful for folks, and I hope I asked all the questions, but if not, we may follow up.
Absolutely. Thank you very much for the forum, Jerron, and happy to do this again sometime.
Okay, thank you. All right.
All right.
Okay, so now we shall move on to our next speakers. Fannie Mae and Freddie Mac still on the still on the mortgage forbearance, foreclosure, and eviction eviction-related provisions of the CARES Act. We have a very great lineup from both Fannie Mae and Freddie Mac. David Boley, Vice President of Government and Industry Relations. Mike Hernandez, Vice President of Housing Access and Affordable Housing Initiative. Terry Theologi, so I messed up your name. Executive Vice President, please fix that. General Counsel and Corporate Secretary of Fannie Mae, and maybe Malloy Evans, Senior Vice President and Chief Credit Officers at Single Family, all from Fannie Mae. From Freddie Mac, we have Teresa Dumais, Acting Head, Government and Industry Relations. Government and Industry Relations, Ben Gotham, Senior Director of Mortgage Servicing Policy, Single Family, Lauren Guerin, Vice President and Chief Business Officer, Multifamily, all from Freddie Mac there. So with that, guys, just jump in. We're so pleased to have you on the call.
That's great. Thank you so much. This is Cindy Danko with Fannie Mae, and I'm actually here on behalf of Malloy Evans. I work in our single family risk organization and am Vice President and Head of Policy for both selling and servicing policy. And so I'll be passing off after I finish talking to you guys about our single family forbearance program. So I'll go through that, and then I'll turn it over to my colleague from Freddie Mac, Ben. Really appreciate you guys having us today. So I was going to provide some background on the single family forbearance program. And we'll start with a recent COVID lender letter that we updated in response to the CARES Act to notify servicers that they must approve forbearance plans for homeowners impacted by COVID-19 and in accordance with the CARES Act. And as a reminder, a forbearance plan is a plan that allows for reduced or suspended mortgage payments for a designated period of time. And with the CARES Act, that length can be up to 6 months with the initial offer And an extension or extensions may be granted thereafter for up to an additional 6 months if the borrower requests it. Certainly shorter terms with extensions of the forbearance may be beneficial to a homeowner if that fits their situation. And for a forbearance, a payment amount can be as low as $0, or the homeowner can pay an amount that they're able to. The repayment for missed mortgage payments is required. However, a homeowner is not required to repay the missed payments all at once or in one lump sum. The CARES Act does state that a forbearance plan must be provided to any borrower who requests a forbearance with an attestation of a financial hardship caused by the COVID-19 emergency. No additional documentation other than that borrower's attestation to a financial hardship caused by COVID-19 is required. The servicer must also inform the borrower that he or she may shorten the forbearance plan at any term to reduce the amount of payments which are being delayed or reduced. And the forbearance plan terms must be provided to the borrower using the appropriate evaluation notice, which must be revised in accordance with applicable law. And that's really a summary of our single-family forbearance program. I'll turn it over to Ben to talk about the options post-forbearance.
Ben, are you on?
Yes, I am. Can you hear me now?
Yes, sir.
Okay. Well, we are all getting used to remote work and how everything somehow gets double muted. So I apologize for that, everybody. I said like a whole lot of great stuff, and I will try to, in 30 seconds, and I'll try to repeat that again. So thank you, Cindy, for the overview on forbearance. And, we have split this up, for single family here because we have done all of this work in alignment. So our policies are the same. So we didn't have to repeat it each separately. So, Cindy's touched on the forbearance aspect, coming out of the CARES Act. I'll touch on the other stuff, which is, and I'll do it pretty quickly given the short time and the ability to answer, ask questions as well. So, the other aspects of policies we have addressed or changed in response to this pandemic, in response to the CARES Act as well, is one, we previously had a policy around credit reporting that requires suppression. That now, given that the CARES Act did address the FCRA and specified what how to report a borrower who's impacted by COVID-19 by a hardship, we just point to the law and say to follow the law so that there's no, potential conflicts between what our guidance is and what the CARES Act said. Additionally, we have, we had previously announced a foreclosure sale moratorium. It expanded under the CARES Act to a, foreclosure activity moratorium for 60 days following March 18th. So that would end as of right now, it would end next week. And that is something that we are, as our, the two GSEs along with FHFA are looking at. We obviously know that the expiration is near. And I, before the moratorium expires, there will be, there will be something that comes out regarding that, right? Obviously, as we continue to work on some of these things going forward, there's only so much, we can talk about out loud, but we do continue to look at all of the issues, not just what's already happened in the past. And then additionally, we announced, initially, Cindy talked about forbearance, what forbearance is and the different rules that apply there. Obviously, at some point here, borrowers are going to be able to hopefully get back on their feet. And having the right post forbearance options is top of mind for us as well. So a couple things in this space. First, in an effort to get something out there immediately after the pandemic struck, after the National Emergency Declaration went out, we did jointly put out that we would make our disaster era mod programs or disaster-specific mod programs available as post-forbearance options. That's our Extend mod, and that is our Cap and Extend mod. And those programs are specifically designed to provide for an option that doesn't generally exist outside of, a major event like this, which is helping borrowers get back, post a major crisis to their normal payment, getting back to resuming their life as it was before this happened. In general times, either somebody can get behind for a short period of time and will catch up through, a reinstatement or repayment plan, or they generally will need more payment relief, in which case our Flex modification offers that. The purpose of those two programs would be to get somebody back to their normal payment. Of course, both programs, as I'm sure everyone is aware, have their flaws, hence the fact that there are two separate programs, right? One doesn't allow for, for the taxes and insurance and escrow items to be taken care of. And, the other one has the component of charging interest on interest. So we continue to work towards trying to find a solution that would take the correct and best components of both of those programs and seeing if we can figure out a way to combine them into one. And, we hope that will be accomplished in the near future. And, and we will announce a program that can combine those efforts together and get the borrowers the help that they need in the most efficient way possible for all of the parties. The last thing that I'll say before I turn it over will be, we did in the midst of all this, we continue to work with our servicers day in and day out during these unprecedented times, call volumes never seen, technology usage that's never been used before. I mean, I don't think anybody's ever gotten a forbearance online before, not before the last 2 months. And, those challenges, as well as, a workforce that is also remote working and, impacted just as well and are doing the same things we all are, and many of them working at home, not only doing their jobs as a mortgage servicer, but being a parent and being a teacher like some of us are. It's very challenging. So, we're working with them trying to, to make sure, they have the support that's needed. Obviously, I'd be remiss if I didn't say that there hasn't been, especially issues that have been, brought publicly, and we continue to try to do that. And the biggest thing there is we wanted to make sure that we would at least attempt to stop a lot of the noise that had been going on a few weeks ago and put out a statement, as well as Fannie Mae and FHA did as well, that, there was a narrative that said borrowers are being forced into a lump sum reinstatement at the end of their forbearance. And we wanted to make clear that that was not the case. And that while reinstatement does sit at the top of our waterfall, if a borrower can afford to do it, they absolutely should. It's best for them. It's best for us. There's no doubt about it. However, we know that most borrowers are not going to be able to afford that, and that is perfectly fine. And it's why we have our entire suite of options. And a borrower will have the ability to work with their servicer to let them know what it is that they can afford and have the appropriate solution, whether that's at the top of the waterfall, I can pay it all back now, or I can pay it all back in a short term, i.e. a repayment plan, or whether it's, falling next, which is I can make my normal payment, but I can't pay any of the additional amounts back right now, in which case, again, today we have our Extend and our Cap and Extend, and we're looking for a solution there as well. And then there's going to be the borrowers who say, I can start paying again, but I can't make that old payment. I just, I lost my job, or I have a new job, I have a reduction in income. And for that, we have our Flex modification. So we have the entire waterfall, and therefore we can find the appropriate solution for what the borrower, can afford once they're able to start making payments again. So with that, I think I am done. And I know we have our partners here from our multifamily groups. And I apologize, I don't remember who I'm supposed to turn it over to now.
Hey, Ben, you asked. Oh, sorry, go ahead. Yeah. Is it for Lauren Guerin? Is that where we're going? Well, this is Cindy, and I was going to go after Ben and talk about one quick thing as it relates to.
Sorry.
That's okay, Ben. We both wanted to highlight the consumer-facing websites that we have that provide information to homeowners about their options as you think about COVID-19 and the impact it may have on them. So at Fannie Mae, we have a website called Know Your Option. It is a consumer-centric website that provides educational tools and resources for homeowners about renting, buying, or selling a home. There's lots of good information on there, but specifically related to the COVID-19 pandemic, we updated the Know Your Options website to provide information on available COVID-19 relief options, as well as video explaining what a forbearance is, a loan lookup tool, so the homeowner would know if their loan is a Fannie Mae owned loan and options available with that. There's also FAQs available. And so we feel that this is a really good option for homeowners who are looking for more information, who've been impacted by COVID-19 and just don't know where to start. And so it gives them great step-by-step outline on how to contact their servicer and have a conversation about their circumstance. And so I think Freddie Mac has a similar website, and they were just going to share some information about My Home.
Yep. Hey, thank you, Cindy. Yes. So yes, for Freddie Mac, we have our My Home website, which has a ton of information. For Freddie Mac borrowers, also has our loan lookup tool, COVID-specific information, and just general specific information as well. So I would recommend everybody, who has, an interest in Freddie Mac policies, all of our FAQs, our different materials, links, reference materials, all that stuff can be found there. It is a great website, and it is being updated regularly as we continue to update things regularly as well, based on the changing circumstances. So, thank you for that. And now that I know who I'm supposed to turn it over to as well, I will turn it over to Lauren Guerin from Freddie Mac's Multifamily. Thank you.
Great, thanks, Ben. Again, this is Lauren Guerin, Chief Business Officer at Freddie Mac Multifamily, and I want to thank NCRC for providing us with an opportunity to outline the actions Freddie Mac Multifamily has taken in response to the COVID-19. As the nation's leading purchaser of multifamily mortgages, Freddie Mac Multifamily has taken several actions to help those facing hardship as a result of the pandemic. On March 24th, Freddie Mac announced a forbearance program for multifamily borrowers modeled on our industry-leading disaster relief plan that was created in the wake of Hurricane Harvey in 2017. Unlike with past disasters, which targeted specific areas affected by national disasters, the COVID-19 plan is nationwide and provides relief to every property with a Freddie Mac performing loan. It also included an unprecedented moratorium on eviction for any tenant living in a property that elects forbearance while it is in its forbearance period. We later revised the program, implementing a handful of small changes to directly align the program with the subsequently enacted CARES Act. Today, if you are a renter living in a property with a federally backed mortgage, including mortgages, loans purchased or securitized by Freddie Mac, you are covered by a temporary moratorium on eviction filings that lasts through July 25th, 2020, as outlined in the CARES Act, regardless if your property elects forbearance. To be sure, renters could determine if they were in a property with a Freddie Mac loan. We worked fast to establish a renter lookup tool that allows renters to determine if they are eligible for eviction relief supplied by the CARES Act or our forbearance program. To further support renters, we established a hotline with HUD-certified counselors who are now offering guidance to renters in need, and we have made sure that this support is available to every renter, regardless of whether the property they live in has a Freddie Mac loan. We've made all of these resources accessible through My Home and through 1-800-FREDDIE. In addition, I believe that these were emailed to participants ahead of time on this call. These resources were previously more targeted at single-family borrowers, but now they provide more information and support to renters than ever. In short, we're doing what we can. It's important to remember that our borrowers are not renters. Our borrowers are the multifamily operators, the landlords. But by extending relief through our forbearance plan, our hope is that some support is ultimately conveyed to the renter. With that, I want to pass over to Mike Hernandez at Fannie Mae for any comments from Fannie Mae.
So we have a Fannie Mae speaker up. We cannot hear you if you're speaking. Someone from Fannie Mae is up and should be speaking now. We can't hear you. David, are you on? David Bowling?
King, he says. So, can you hear me?
Yes, I can't hear you. Who's in that?
So Mike Hernandez is supposed to be speaking. He says he is speaking. So, not sure if there are technical issues going on. I can jump in here real quickly. So I know that what Mike wanted to talk about, and hopefully, he'll jump in, is the renter resource tool that we've put on our Know Your Options site, which Cindy Danko referenced earlier. We have a disaster response network that we have utilized in the past for homeowners when there has been a significant natural disaster, such as Hurricane Harvey, Hurricane Irma, and what they do is they provide counseling to two individuals that may have been affected by that disaster. What we've been able to do is utilize the disaster resource network to work not just with homeowners, but also with tenants in Fannie Mae multifamily properties. And so under our rental resource tool, a tenant can put their address in, determine whether it's a Fannie Mae finance property. If it is, then they will receive information about the disaster response network and the counseling opportunities that are available to them. And so that's what Mike was going to talk about. But I've tried to cover at least at a 30,000 foot level, and we can certainly respond to any questions people may have.
Yeah, well, let's go to questions, and hopefully, whenever Mike can speak, get on. We will go back to that, because that renter resource tool provided by both Fannie and Freddie, it's not only a renter resource tool, but you got the homeowner loan lookup tool. Both of those tools are really critical resources. So let me just start. Do you have other speakers other than Mike? Because if you all do not have other speakers, we'll go to some questions.
No speakers on the Fannie Mae side.
Freddie?
Hey, this is Emma. Hi. Yes, we're finished. Sorry, I forgot the star 6 there. This is Teresa. Yeah, we're finished.
Yeah, that technology. Okay, let me just start with a few questions, because we do have several lined up here. With FlexMod, I hope if I'm getting the GSE and FHA questions mixed up, just point that out. I'll go on to the next one. With FlexMod, there are limits and specific guidelines. What if the borrower has exceeded or does not meet the FlexMod guidelines, flexible modification guidelines? What options would be available?
So this is Teresa. I think Ben, our single family guru on all things servicing, just got booted off the call. Cindy, do you want to hop in and take this?
Sure, happy to. Sorry, can you guys hear me okay?
We can.
Okay, good. The call's in and out. So I think the question was, if a borrower doesn't qualify or meet the guidelines for a FlexMod, what other option might there be?
Yes.
Yeah. The FlexMod is at the end of the solution waterfall. And so the servicer would then work with the borrower on any, proceedings that occur if they can't meet the FlexMod requirements. So, for example, the short sale or deed in lieu.
Okay. And can you briefly state what the waterfall options again after the forbearance term ends? Can you just briefly restate that? And I am getting that question. I got that a couple times.
Okay. So as Ben mentioned previously, they include reinstatement, a repayment plan, the extend mod, the cap and extend, or the flex mod.
Okay. Can the servicer require financial documentation from a borrower to qualify for, I think this is you, for deferment reinstatement option?
Hey, Cindy, it's Ben. I'm back. I apologize, everyone. I got dropped off. I can take that one.
Awesome.
No, there is no documentation required. So, and I will say there's no documentation required on any of our loss mitigation options, with one exception. So for reinstatement, there would be nothing required in terms of verifying financial information, repayment plan. Our existing payment deferral product, which we haven't talked about because it's not actually available until July 1st. Also doesn't, the extended mod, capping mod don't, and flex mod generally does not. It doesn't if the borrower is 90 or more days delinquent. So if a forbearance is 30 days, has missed 3 months payments under the forbearance, there would be no documentation required. In the event that a borrower has only missed 1 or 2 payments and is less than 60 days delinquent, under the terms of our security agreements, they do have to be reviewed for imminent default, and return certain documentation, very limited documentation in those instances. The only other thing that I will say for anybody is, I think the last question was, what if somebody can't qualify for flex mod under the general terms, which I think most people know is a 20% targeted payment reduction. In the event that you pull all the bells and all the strings, and somebody still can't qualify under the normal terms, we do allow for servicers to collect additional information to submit to us for exception processing in those instances too. So outside of those limited examples in flex mod, either really early in delinquency or for exception processing, there would be no documentation required at all.
Okay, excellent. Let's see here. I did have another. This is a pretty detailed question. If my client, let me go with this housing counselor question. How can housing counselors sign up with Fannie Mae backed lenders to help homeowners and renters?
Hey, Dave, can you hear me now?
I can hear you. Is that Mr. Hernandez?
Yeah, it is. Karen, I apologize. Yeah.
Go ahead and present. We had gone to questions. Go ahead and present your part because I think it's important.
I'm just going to highlight a few things just because David did such a fantastic job. One, on our disaster response network that we created to help homeowners and now renters. It's a partnership with Money Management International of Atlanta, HUD-approved housing counselor, and they will provide up to 18 months of counseling support to homeowners and renters to help them with their finances, to provide financial counseling, budget counseling, help them connect with unemployment benefits, food stamps. And then now with COVID, we pivoted that to also help them engage with their servicer and to get the resources that they need. They don't provide they don't provide legal support or information, but they do help them avoid scams and those type of issues out there. And we're real excited to be able to have that resource. It's already been hundreds and hundreds and hundreds of families and renters and homeowners. And it is available to both owners and renters that live in either a property financed by Fannie Mae or a mortgage owned by Fannie Mae. And Cindy mentioned our Know Your Options. You can go to Know Your Options to access that site. And if you're a renter or even a homeowner that isn't have a mortgage financed by Fannie Mae, you can still get a lot of valuable information on how to connect with other nonprofit counseling agencies across the country to get the support that you need. We've always been committed to creating sustainable mortgage financing and always committed to help borrowers and renters in need. So, Darren, thank you so much for giving me just a few minutes to share that information. And sorry for my technical difficulties.
No problem at all. We're all happy. If my client is 4 months delinquent and now is getting the forbearance, how will they be handled when they return to work? For example, will the forbearance and the delinquency be lumped together and resolved, or will each be dealt with separately? Their fear is the forbearance will be added in, and they will be foreclosed on for not being able to make the 4 past due payments as lump. Did you get all that? I hope you did.
I got it. Cindy, you or me?
Go for it, Ben. I'm sure we have the same answer.
Yep. So, no. So, yes, it will all be added in together, right? So, a borrower, in this example, a borrower is 4 months delinquent, and now, which means they already had a hardship of some sort, has not been resolved, and now they're impacted as well by COVID-19, which will allow them for, potentially up to another year of forbearance under the CARES Act and our policy. At the end of the forbearance, when the borrower is able to resume making payments, assuming they are able to get to that resolution at some point, we do know some won't. But if they are, that entire length of missed payments is what will ultimately be is owed, and it will be either paid back in a lump sum, not likely, or repayment, again, not likely, or it'll be added into the modified balance when the borrower does something like a flex mod, which takes the past due amount, adds into the balance, runs through a waterfall with interest rate reduction, term extension, et cetera, to get the borrower payment relief. That's the point of that program. So there will not be, resolved the forbearance period for COVID over here. Now you have to make up this other set of payments over here. It's all one mortgage, and it's all one, set of missed payments that will be addressed, and whatever the loss mitigation solution is.
Okay, 2 more questions here, and I will wrap this up. I did get a question about force-placed insurance. We asked this of FHA in the partial claim context. Can you all address force-placed insurance, and will that be put on the loan, driving up the escrow? That's all I can say. They asked about force-placed insurance. So,
yeah, it's Ben again, so I can take that. So as it relates to lender, we call lender-placed insurance. As it relates to that, I think first and foremost, everyone needs to be aware of CFPB's rules, specifically Regulation X, and I can't remember the exact section, but I want to say it's 102.4.37, which is specific to escrow and what must be paid out of escrow. So the servicer is required to continue to advance payments, and the servicer may not stop advancing the payments in the event that the borrower misses them, and therefore they will continue that. The only time that lender-placed insurance comes into play is if the insurance carrier drops coverage, which will either be because the borrower requested it or for whatever reason, but the servicer cannot stop making the payments in order to have that coverage canceled. So in the event that a borrower requests it to be canceled, or the insurer declines to re-up the policy, yes, it's possible that the borrower does not get a new policy, and therefore the servicer would have to obtain lender-placed insurance as opposed to not having the property insured at all. But absent that scenario, the borrower is in complete control whether there is an insurance policy or not, and the servicer is required to advance those payments during that time that the borrower can't make the payments.
Okay, thank you. In our remaining minute here or so, can you address the housing counseling question? We did get a question about how a housing counselor can sign up to help borrowers in this instance, but that may not be possible. Can you address that? And also, can you address in the remaining, these are the last 2, how a housing counselor, intermediary or whatever, can sign up, and 2, the mortgage servicer liquidity issue. Can you address that in your remaining moments here? And I can explain the mortgage servicer issue. I'm sure you know that liquidity concern. They still have to advance pay taxes and insurance and principal and interest on mortgage payments that are forborne. And this is obviously a big issue. If there's anything you can say about that, please do. And then also address the housing counselor piece.
Hey, Lauren, this is Mike. Can you hear me? Yeah, I was going to say I'll take a shot at the housing counselor piece. I would just offer that for Fannie Mae, at least, right now we're offering our service in partnership with MMI, but we strongly encourage our lenders to work with third-party counseling agencies. Many of them have relationships already that they're working with to get additional information out to their homeowners. And then the other thing we've seen on the multifamily side is a lot of the landlords are also, some have created not-for-profit, others are partnering with local not-for-profits to help their residents, deal with the financial crisis that they're in. So I think another opportunity might be to reach out to the local landlords in your area, especially the larger ones that may have resources to be able to support these type of efforts. I think everybody is looking for innovative and creative solutions to help residents, whether they're homeowners or renters, to deal with their current financial crisis.
Hey, and this is Teresa with Freddie Mac. I just want to, on your second question, Jerron, related to servicer liquidity facility, the FHFA director has spoken about this issue, so we have to defer to FHFA on that question.
Okay. I figured that was going to happen.
Sorry.
Okay, I really think I may have some follow-up for you as well. There are a couple other questions here I may have overlooked by accident, but I thank you so much for spending this time with us and offering your expertise on, all of these questions. I mean, we're getting them, so I just wanted you to have an opportunity to answer them. Thank you so very much.
Thank you.
Thank you.
Thanks, Ron.
Thank you.
Thank you. With that, again, I'm Jerron Levi, Director of Government Affairs here at NCRC. glevi@ncrc.org. There are quite a few questions here. We'll try to, as much as we can, get answers to those, but feel free to email me and we'll try to, get answers to your questions as best we can. Thank you for joining us and have a lovely afternoon. Yelling about how I see our kids all the time, or how I don't trust jobs.
So did you hear any of it? I just noticed that the mute was on. So, well, it was there on the screen. Okay. Appreciate your time, everybody. I'm going to not hearing anyone asking any questions. I am going to end the call. So we're down to just 4 people in the call in any case. All right. Thank you for your time. And this call is now ended.
Can you hear me?
Yes, I can.
I'm on Kofi's phone. I was on the computer, and Kofi left his phone here. He went downstairs. Did he answer your question? Did they answer your question?
Yeah, they answered some of them. Some of them they said that they'll send directly, and I am going to call you directly because we need to talk on what was happening. You did see that the whole viability of the Black Folks Plan, that there's plenty of funding in the PPP for the implementation of Black Folks Plan. Okay.
I couldn't understand I couldn't understand. You called me back.
All right.